let's start, Brian Sozzi, with our old friends over at Under Armour. The company continuing to ride its turnaround program, seeing strong results as this athleisure moment, the reorientation of the Under Armour business towards D2C, away from your traditional kind of big box setup. We see a beat on the top and the bottom line, and it has, really been some time since we've started to string together a couple of nice quarters for Under Armour.
Yeah, and this is just continues a theme we have seen from these wholesale retailers. And when I mention wholesale retailers, it is those retailers that traditionally sell into department stores. We saw it from VF Corp last week. We're seeing it from Under Armour today. We saw it from Levi's a couple of weeks ago. Retailers, department stores, they need more stuff. People are out there rebuilding their closets, and they, at least this quarter from Under Armour, suggests people are going back to Under Armour and buying some of their new clothes, which I would say they have shifted the aesthetic of this brand. A lot more streetwear as opposed to old school Under Armour, was just pretty much selling workout clothes. But interesting here, you saw the international business up 133% in terms of sales, North America up 101%. Where I do want to highlight a red flag, and you're seeing the stock up here 6% because of some of those strong numbers here. Gross profit margins only up 20 basis points. And here you have Under Armour calling out that they had to have pushed through higher prices, likely because of inflation in the supply chain, like a lot of other retailers. But again, if there's a red flag, that would be it.
But, let's dig in a little bit more on these results because, Patrick Frisk talks right in the beginning of the release about the transformation towards more D2C sales. And we've seen a consistent kind of move away from them wanting to be quite as much wholesale. But when you look at the revenue line, wholesale revenue up 157%, D2C up 52%. How are analysts to think about this company's turnaround stage at this point?
I still think you think of Under Armour and a Levi's. I know a lot of them have pushed aggressively to open their own retail stores. Traditionally, that is a higher margin opportunity for a lot of these retailers. They want to control their own brand. That is where they put a lot of their best stuff. But when I go get Under Armour, I still go to Dick's Sporting Goods. I still go to a Macy's to buy this apparel. Worth noting, too, here, e-commerce sales for Under Armour down 18% in the most recent quarter, likely as people obviously stocked up last year online. They didn't do so this time around.
Something else for Under Armour, just thinking about the longer-term story here, and of course it is really, a darling of the retail industry, having gone through several different lives over the last several years. Record high on the stock back in 2015, just under $50 per share. This morning we're set to open closer to 22. The highs for Under Armour shares going back to the middle of 2019, right around 25. I think that's probably the most important level there to think about the stock, maybe making a run back towards those record highs. It's still, Brian Sozzi, a tough go for long-term Under Armour investors.
This is a different company compared to a decade ago. That was a very, very hot growth brand that came out of the gate, seemingly out of nowhere, and captivated the minds of consumers with a different product, that tight-fitting, black, moisture-wicking shirt, which essentially created a whole industry. I think the Under Armour today is more of an expense-cutting type of company. They have cut hundreds and millions of dollars in expenses over the past 2 years, and I think that's why you're seeing the results that we are.
And I think, about that trajectory, an exception to the idea that we talk about so often here. When you become a verb, then when your name becomes the product category, I'd say I need to get some Under Armour. I'm saying I need to get some base layers. They actually didn't end up capitalizing on
base layers.
Well, right. I mean, that's sort of what it was. You just said I need Under Armour, but now Nike makes it, and
I'm from the era. Maybe it's just boomer me. I remember an era there were no base layers. There were no of this stuff.
Well, I remember. It was just coming out like when I was playing middle school football, and the transition from just wearing a turtleneck underneath my pads to trying to convince my parents that this $40 shirt with a turtleneck was worth it. They're like, why can't you just wear a turtleneck? It'll be fine.
You still have the shirt?
No, it was like a youth large. Like I can't fit in that. All right, let's move on here and talk a little bit more about, I guess this is Jason the Under Armour trade, the malls. We see Simon Property Group out last night, being on the top and the bottom line. CEO David Simon jumping on the earnings call last night, though, Sozzi. This is a fun one. You gotta love this kind of commentary on the call, really letting it all out there.
David Simon has historically been one of the most outspoken people, not in the mall space and in retail, and his conference calls are always must listen. I have a story right now on the top page of YahooFinance.com looking at some of his comments. But Simon's saying this, quote, "The mall is safe. Even though we're starting to see counties talk about indoors, there's no science about the mall." I think he was referring to COVID spreading inside of malls. I underline that. We have been mistreated in this whole 18-month ordeal, but it is what it is. He goes on to say, next question.
Yeah, well, so the setup for that question, analyst over at Piper Sandler, Alex Goldfarb, basically asking about the spread of the Delta variant, and Simon began his answer by saying, so the land of the Ozarks, you only know that through the Netflix show, right? But I've been there, and it's a wonderful place, and then goes on to talk about the setup there. Something else that stood out on this call that Simon mentioned is their sales are back to, their sales in June of 2021 were in line with 2019. Hitting on a theme we've continued to discuss on this program, companies comparing on the 2-year stack to give us a better sense of the business. And, granted, Simon has a preferable mall footprint, relative to where most operators are. But I think encouraging for the overall retail space to see them talking about sales getting back to 2-year-ago levels.
Yeah, historically, Simon doesn't operate trash malls. It is some of the best malls in the game, a lot of A-list. Interesting stats, though, deeper down on its earnings release. The number of properties for Simon Property, U.S. malls and its premium outlets, 164 versus 168 last year. Square footage, 138 million square feet versus 142 million last year. Occupancy levels, 91.8% versus 93% last year. And the theme is here, this is still a different company. I know they're out here touting a generally upbeat quarter here. Net income improved a lot, but the pandemic has had a profound effect on the mall space, and you see it in these results.
And I think, also to go back to their comments on the sales getting to 2-year-ago levels, they actually add, or Simon adds on the call, if you exclude 2 well-known tenants, and we can maybe guess who those are, our mall sales are actually up 8%. So to your point about the transformation of the footprint and that occupancy level, the idea of an anchor tenant, which of course is how you typically set up a mall, continues to fade. And I think the company here is signaling in part that they want, as everybody likely does, to move away from that sort of model, because you can see the drag that some of those big brands with their struggles end up bringing you down. Yeah,
we haven't really seen the great redevelopment of the mall to the extent we would have. We've seen pre-pandemic, you put rides in there, you're trying to gain traffic, but haven't seen a lot of grocery stores come to the malls, haven't seen a lot of fitness chains come to the malls. It hasn't lived up to expectations.
Yeah, it's more challenging. I mean, it's the same reason that, an ad sales team, you think about it's easier to sell $50 million for the Olympics than it is to try to piece together 500, $10,000, $100,000 deals along the way, along websites and so on and so forth. So same kind of idea. All right, let's move to a company that is clearly not having a nice comp compared to last year. That's Clorox. Stock's down 10% on this news, which you kind of see the headlines here, and you sort of think, well, I mean, yeah, of course, 9% decrease in sales, 10% decrease in organic sales, earnings down sharply, certainly some inflationary impacts there, but did anyone think that we were going to be stocking up on cleaning products at the same level we were in the same quarter last year? Sozzi, what's the story here with investors punishing these results?
This is a tough one to take because for as long as I've covered Clorox, probably 7 or 8 years, I've only known them to have generally good earnings days, a lot of consistent results. But what you're seeing from Clorox today is a complete resetting of street expectations here. You saw sales down across the board. Trash bags, disinfecting wipes, a major call out of almost 1,000 basis points of gross profit margin pressure here because of higher logistics costs, higher commodities costs. And these are the same things we heard from a Procter & Gamble, a Kimberly-Clark in terms of their earnings for the past 2 weeks. So if you have not been living under a rock the past 2 to 3 weeks, you had to have seen this quarter coming from a Clorox. And if you did come out of that rock and went to a Target or Walmart, you would see there's still a lot of unsold cleaning products on the shelves being sold at severe discounts. That is not good for a Clorox. And on complete resetting those expectations, for the next 12 months, Clorox is looking for $5.40 to $5.70 a share in terms of earnings. That is adjusted. The street was at $7 $6.60. And now the company's going back and saying it's looking at some restructuring here to hopefully do better than those results. But this is a shocking quarter from Clorox.
Yeah, well, I mean, so there you go. I mean, that explains the drop in the stock, right? You come out and you guide 15% light of earnings estimates, and that, we're not even getting to the full 15% discount you're seeing there. But yeah, I think, Soz, that was an interesting kind of bringing those three names together: PG, Clorox, and Kimberly-Clark. And we've thought a lot through the pandemic about what are the companies that reset their business trajectory, right? What are the names that can come out and say, during the pandemic, we transformed in this way, and now our business is growing at this pace. Let's call it, we can say, we're growing 7%, we were growing 5%, so on and so forth. I think what you're hearing from those three, major household consumable products, even the higher end brands that people are willing to pay for, they are not on a new trajectory, right? They are kind of getting back to that inline, maybe slightly better than GDP growth. Throw a little financial engineering on there, and you grow earnings a couple percentage points better.
And what do you do? Because during the pandemic, a Clorox and a lot of other companies, and it's not just cleaning products, it's also the food space, they have invested a lot in people and capacity. Well, you're not going to close down this new facility you built to support future growth, whatever you thought it was. So that's just higher fixed costs. Ultimately, what it means, higher prices for folks like you and I.
Adjusted EPS results primarily reflect higher manufacturing and logistics costs, partially offset by increased shipments across all four segments. So sounds like you cannot make it up in volume, at least if you are Clorox.